So bonjour from Austin and welcome to the panel, One-Stop Shopping, pushing only one door to finance your ClimateTech startup and the assets you need to deploy. I'm Alex Raguet. I'm the president from French Tech Austin, and I will be the moderator from this panel. For the one that have been following the two previous panels of today, we're going to talk again about climate change and about impact. And the theme of the day will be funding a better tomorrow. I think there is no better subject than funding climate tech with innovation. And the trend, the innovation I've been seeing, and that's why I asked my three speakers to join me today, is this new way of financing a climate tech with one closing, when the climate tech can get financing in capital for the startup and at the same time for the assets that it needs to deploy. So I'm going to be joined today with three leaders in the field. As an introduction, I'm going to explain why I choose them. So the first speaker is going to be Jerome Petitjean from Demeter. And for me, Demeter was a pioneer in that kind of field of mixed financing in equity and in infrastructure. And Pierre is going to give us the history of solar 10 years ago, where they were investing in a developer. They were helping to finance the solar farm. So after listening from a VC, a French VC that is doing infrastructure, we're going to listen to Karine Merere from ADEM Investissement. ADEM Investissement is more an infrastructure player on the public side, but it's getting very close in some deal to some VC too. And Karine is going to explain, there's a beautiful schema that I already seen, how it works exactly. And for our third speaker, we're going to go back across the Atlantic, and we're going to have McGeough from Energy Impact Partner that's going to showcase the example that made the headline a few months ago of Home Connect raising money to finance the company with 20 million and 80 million from the infrastructure too. Karine is operating partner, Energy Impact Partner. So there is one house rule that is quite important. We have 30 minutes. So each speaker is going to have 6 minutes each to explain who they are, who are their companies, why and how they are doing this mixed financing. And we're going to have 10 minutes for the discussion. You're not going to be able to ask directly the question to the speakers. So as a moderator, I'm going to ask you to put them in the chat, and I'm going to compile them and ask them directly to my three speakers. Okay, I think I said everything, so we can start. Jerome, if you want to start with for Demeter. Thank you.
Okay, thank you, Alex. I have just one slide for my presentation. I don't know. I have to share my screen or not?
Yes, you should be able to do it.
Okay. Okay, let's go. Is it okay? Can you see the slide? Yeah, okay.
Yes, we can see.
So thank you, and thanks for attending this presentation. And thanks, Alex, to give me the opportunity to present Demeter and a deal we recently made called ZWay, a mobility service. So my name is Jerome Petitjean, and I'm a partner at Demeter in charge of infrastructure investment funds. But in fact, Demeter is a French-based private equity management company created in 2005. And all our investment funds are only focused on the energy and ecological transition. And of course, we usually invest from 1 to 30 million euros to support companies at all stages of their development, including investment funds in venture funds for innovative startups, growth funds covering fast-growing SMEs, and infrastructure funds investing in projects. So we try to set up ESG best practice, and I think we have a unique environmental impact platform covering all the stages of companies and projects for energy transition. We have currently 1 billion euros under management through something like 10 investment funds. And we've made 170 investments since 2005. All these investments were dedicated to energy transition. And with all our investment funds, we try to cover all the market sectors, including mobility, green mobility, agricultural tech, renewable energies, energy efficiency, and so on. And to move on our subject, I just try to change my slide. Sorry. Yeah, it's okay. And so to move on our subject, yeah. We think ZWay, which is an innovative mobility services, is a very good example addressing an approach combining venture and infrastructure, in fact. Because I think that new companies for mobility services, especially, but it may be the case in other innovative market sectors, of course, may face the limits of private equity market. Some companies offer new innovative mobility services, but without any track record or performance or traffic, and then without a proven business model for traditional infrastructure funds targeting predictable and recurring cash flow, in fact. And on the other hand, transport infrastructure or services are capital intensive, which generally leads to investment needs greater than the amounts allocated by a VC fund. So with this example, ZWay is an example of investment we've just made within this double combined approach. And so ZWay is a new player in electric mobility, offering a service of personal electric scooters with swappable batteries in a network of stations deployed throughout the city. And the service is now launched in Paris with 40 swapping stations already installed in Paris. And of course, battery swapping allows to charge in less than 1 minute. And in this deal, our investment with an infrastructure fund was made along with other investors, especially Allianz Insurer and Waterstart Capital, another VC fund, to launch the service. And it includes 2 levels of investment. The first one was 7 million euros of capital increase at the corporate level of ZWay with equity to ensure the development, the commercial development, and the hardware development and management of the company and of the service, mobility service. And 8 million euros of convertible bonds as additional funding to finance the ramp up at an asset co level to finance the swapping station, the batteries, and the electric scooters. So in this deal, we have a mix of venture capital approach at ZWay level, and of course an infrastructure like approach at asset co level to finance all the platform, the hardware, and assets. And of course, ZWay owns the asset co, and an intercompany agreement has been set up between ZWay and ZWay Asset to cover all the service management, customer management, business development, and scooter maintenance. Because of course, in this mobility services, we have a global offer covering insurance, maintenance, and a limited access to swapping station to use your electric scooters. And on the top of that, this asset co has a contract with users, which may be personal customers that we, under a leasing contract for a period between 1 to 3 years. And of course, B2B users as well, and especially fleets for last mile delivery with electric scooters. And so we have all this contract, users contract at the asset co level. So I think in this case, it's clearly, I think, a good example of innovative startup with innovative service for energy transition, and a mix of corporate and infrastructure approach to found this project and to develop the service with, of course, huge needs for funding at the beginning of the project, considering that we have to finance, of course, swapping station at first, hardware platform, and then after that, we have to finance batteries and electric scooters for final users. So in this case, and I think this is a kind of trend in this market, and not especially the market, the mobility market, but I think this is more and more current scheme of funding with this two-level corporate and asset co level.
Okay, thank you, Jerome. Is that it, or can we?
Yeah.
Yeah. So thank you, Jerome, for this great example. Now we're going to move to Karine Merere, Deputy CEO of ADEM, for another example. The floor is yours. You are on mute, I think. Yeah. You're on mute.
Not supposed to be on mute. Can you hear me fine?
Now it's good. Yes.
It's superb. Okay. Well, I'm not the deputy CEO of ADEM, the French agency for ecological transaction. I'm the deputy CEO for ADEM Investment, which is in fact a investment vehicle that is in the ecosystem of ADEM. So as I said before, the French agency for ecological transition, and we are. You've mentioned it, Alex, before. We are a publicly funded company. We were created by the French state through a program which is called the Programme d'Investissement d'Avenir, so Investment for the Futures program, approximately 2 years ago. We have a 400 million euros envelope that is dedicated to invest in infrastructures, in equipment, in assets, in all the sectors of the ecological transition, from energy to energy mobility to agroecology, biodiversity, so pretty much all the sectors you can think about. We typically look at project financing structures, but not all the projects. We focus on innovative projects, not innovative in the sense of R&D, but in a sense of first of a kind projects. So first commercial operation of a new technology, a new equipment, or sometimes also a new business model. That's the example I'm going to talk about in a few minutes. Last point on ADEM Investments, we invest in equity, in quasi-equity. We always take minority stakes, and we can invest in France and also abroad for part of our envelope. 100 million out of the 400 million can be invested outside of France, but in each case we will look for a French angle. So if we invest in projects overseas, we will look for French interest, either supporting a French techno or going together with a French player. Switching to the topic of the discussion, and before getting to the example, I wanted to share views about the trend of the market that we have already touched about in your introduction, Alex, and Jerome, in your presentation, which is a shift from infrastructure finance, the typical plain vanilla energy, renewable energy project, to the financing of small, decentralized assets or equipment. So the bulk of the money still goes to the plain vanilla renewable project, but we see more and more of these projects that are on the edge of this transition topics. So it started with fleets of vehicles, it started with the energy efficiency, but we see now this more and more relevant in the decarbonation of the industry or decarbonation of other sectors that have an issue with their carbon emissions. I'm thinking about the maritime sector, for example. So why do we see this trend? We think it's linked to the as a service approach, where it's easier to take the decision to rent an equipment. So there was the example of the electrical scooter that Jerome mentioned before. It's probably easier for the user to rent the scooter than to buy it. The same for the industrial player. It's easier to rent an equipment than to buy it, in particular if it's a new technology or new equipment. So we see this as a service approach and this structure as a very strong driver to the deployment of these equipment that are critical to the transition of reaching the targets of our carbon reduction. This trend is virtuous for the reason I've mentioned, but it also puts pressure on the financing of the companies, because not only they have to finance their own corporate needs, fund their recruit their sales force, support functions, maybe continue financing some R&D, but they also need to fund those assets. And as Jerome mentioned before, it's not unusual to see that the asset financing is for a much bigger amount than the corporate funding requirements. So therefore, the need, how do we address those two funding needs? One way could be to fund everything at corporate level. We tend to believe it's not super efficient. And again, Jerome mentioned it before, it's not the same amount, so it can be difficult for VC to fund the assets. Return expectations are not necessarily the same when we're looking at assets and we're looking at corporates. So we see more and more these two structures with corporate funding and asset financing. So I'll also try and share my screen to present the example of a transaction we have recently announced. Can you see? It's all good?
Yes,
okay.
We can see it.
Super. Super. So we announced in September the parallel closing of the corporate funding and the creation of an asset co with a company called Ecotech Ceram, ETC. ETC has developed an equipment that is called the EcoStock that stores heat, and then this heat can be reused either in industrial process or to produce electricity, for example. And the company had already sold a couple of those equipments, but they realized that if they wanted to accelerate the ramp up and to deploy more equipment, they needed to provide a financing solution to their clients. So as I mentioned before, it's easier to rent an equipment, particularly if it's new technology, than to buy it. It's even more the case if you're trying to replace an operating expense with ideally a new operating expense. So it's easier to replace the operating expense with an operating expense than to replace with a capex. So providing this financing scheme and the possibility for the client to contract the equipment through a lease contract or as a service contract is a strong commercial support or commercial agreement for the company. So they have together with a pool of financiers that is shown on the picture, secure both financing at the same time, 5 million euros at the corporate level and 15 million euros at the asset co level. In this scheme, you see that most of the investors that were present at that are present at corporate level also come at the asset level. We have at the asset level a mix of equity, shareholder loans, and convertible bonds, and it provides for very good alignment of interest between the investors. In the case of ADEM Investment, we came only at the asset co level, so investing ETC Invest. However, we have a continuum of the public financing because at the corporate level we have BPI France and a fund that is also part of this investment for the future programs that I mentioned before. So what are the advantages for Ecotech Ceram? It provides funding solutions that are fit to the funding needs. We've mentioned the reasons before. It provides scalability because at the asset co level, we have organized to be able to support the ramp up and over time, over a couple of years for the sale of the equipment. And yeah, as mentioned also before, it's a powerful commercial tool to accelerate the deployment of the equipment. There are some flexibilities around the structure. You can organize in this case, it was closed at the same time, but you can have first the corporate funding, and in the second step, the asset co-creation, in which case there are some agreements to be or terms to be pre-agreed regarding the asset co, but it can come in 2 steps. In particular, for example, if you want to invest or fund the first projects at corporate level and then wait for some market feedback before creating the asset co. And you can also, that was the case presented by Jerome, have different investors at both levels. Both options are fine. Maybe just to wrap up, this type of structures has a lot of merits for the company. We also see that it has a lot of merits for the transition and the decarbonation of industry and other sectors. So we look forward to finance more of those in the next months and years. We can't hear you, Alex.
Oops. Okay, I was saying thank you, Karine. And now it's going to be Caroline, McGeough, to present what is happening on the US side.
Great, thank you, Alex. Just to briefly introduce myself, so my name is Caroline McGeough. I'm the head of infrastructure investing at Energy Impact Partners, which is a $2 billion clean tech venture firm based in New York, but with offices globally. And so my focus is primarily on working with venture-backed portfolio companies to build new types of infrastructure assets. These are entirely within the sustainability realm, and we invest across the grid edge space, mobility, where we're focused on food electrification, urban agriculture, where we're focused on growing produce more sustainably in urban environments, and lastly on industrial decarbonization, where we see a lot of interest from large corporates and as a service models, as Karine was describing. Before joining EIP, I was a founding principal and one of the senior team members at Sidewalk Infrastructure Partners, which is an investment platform that we set up through a joint venture with Alphabet, Google's parent company, and Ontario Teachers, which is one of the largest infrastructure investors globally. There we had a unique model where we were able to do everything from seed stage investing to later stage buyouts, and we invested in a few fairly innovative platforms across the virtual power plant space. We incubated a company to develop roads for autonomous vehicles, and we also invested in recycling technology to boost the amount of plastics that we're recycling. And so I'll talk a little bit about, I guess, last thing to mention my background is previously, prior to that, I was a traditional infrastructure investor for about 8 years. So worked at large private equity firms with an orientation toward energy and industrials investing. So I'll talk about a few sort of trends that we see in our portfolio today. So one is we see huge project capital needs in our venture business. And this is maybe a little bit surprising to some because they feel like, not the group on this call, but venture infra can feel like separate ecosystems. But actually we've seen $6 billion of project capital that's already been raised within our existing portfolio to fund new types of assets. So solar, storage, and microgrids are the largest examples there. And so you may ask, why do those companies need this form of capital? One, it helps mitigate dilution, right? So you use third-party funding to build a new type of asset while retaining as much ownership of the company as you can. And there's less potential for multiple re-rate, right? So if you're extending into an asset-heavy line of business, your venture investors may say, that sort of has the potential for multiple compression over time as you get into that line of business. Whereas if you use third-party funding, that's much less of a risk, for example. Two is we see a limited number of funds that are active in this space. So I think we still see, fairly low competition for this deal flow, which is why we've decided to establish the capability internally to be able to support our portfolio companies as they scale into building new types of assets over time. For a $100 million climate infrastructure asset, for instance, it's unlikely that a $500 million venture firm would be the firm to support you in building that, right? So we see, increasingly a need for venture investors to provide project funding or sort of partner with those funds that do. And likewise for infrastructure investors to increasingly build up the capability to do corporate investing in early stage companies. We also see corporate contracts changing. So as corporates have committed to sustainability goals, this is resulting in longer term commercial agreements that can help support getting a new type of asset financed. We're no longer in the era of having 10 or 15-year PPA. But in the agriculture space, for instance, we see some medium-term deals where Whole Foods, for example, would commit to buying leafy greens for a few years at a time, which helps to de-risk an infrastructure investor's commitment. And then lastly, I think we see, now that solar and wind have effectively completed their journey toward maturity, that has provided us with some very interesting examples of how to effectively finance a new type of infrastructure asset. And I think we now have enough alumni, who have started businesses in fleet electrification, for instance, who are coming from renewables, who are interested in using project finance as a tool to scale up an emerging asset base. So quickly on the OhmConnect deal, so this is a deal that I led when I was at Sidewalk Infrastructure, $100 million commitment to finance a very new type of asset, which is residential virtual power plant. So think of consumers in their homes saving energy, whether that's because they've linked up their Nest thermostat and it's being controlled to save energy for the grid during a moment of need. And so what did this project financing provide for OhmConnect? First of all, it was non-dilutive funding, right, to scale a new type of asset. Previously, they had been operating a virtual power plant on their balance sheet, which is challenging, right, from a net working capital standpoint, and introduces volatility in their performance. And so by shifting that off balance sheet, that enabled them to really, grow the asset much more effectively with third-party capital. We also paid them for services, right? So they were able to get some recurring fees, a profits interest in the virtual power plant, and then we were able to bring a pretty interesting partnership with Nest to the table that helped create advantaged economics on a smart thermostat component of the portfolio. And I think what we see in this space is the challenge to get the first deal done. First deal in a space is always the hardest, right? And establishing that precedent for the market. Once you have deal number one, deal number two looks better, and you're able to sort of drive improvement in terms, you bring other investors into the structure, provided that the performance, is consistent with expectations. So happy to share more. I know we're coming up on time, but if folks want to learn more about that case study, feel free to reach out to me directly. But I think it's a good example of the types of needs for capital that we see in our venture ecosystem and the type of deal that we're pursuing hand in hand with our portfolio companies at EIP.
Thank you, Karine. So I'm going to share my screen for people who are interested to connect the three of you directly if they have more questions, or if they have a climate tech that they are looking to fund and they are interested to do this mixed funding. So that's I think that if they are interested in the US or in the Europe, they have a good idea. My first question for you will be, what kind of technology will be fitting this kind of financing? I know, Karine, you talk about financing as a service. So for the scooter, for things like that, we saw an example of VPP, we talk about solar. What other kind of technology do you think would be a good fit? I don't know who wants to start.
Perhaps I can start on my side. As we can see currently with new, I would say, market sectors, I think that the same approach could fit with other, of course, market sectors like, and especially in agricultural tech sector for some innovative services or production process with needs for assets and other measuring systems, for example. And I think this is also the case for a circular economy and all the industrial processes linked to, of course, circular economy, including new materials, new industrial process in this specific markets and huge market sector.
Anyone else? Karine, Caroline, or there is a question from Andrea in the chat. If you want to reply directly to, don't hesitate, or continue to reply to my question about which segment could be a good fit.
Maybe just to complement on Jerome, I agree on the sectors he has mentioned. I've mentioned maritime sector earlier. We see this type of structures also potentially applying in the hydrogen sector for some niche usage of renewable green or decarbonized hydrogen. So in fact, there's quite a large scope of sectors and usages that could work with this type of structures.
Thank you, Karine. Okay. I've been told by the organizer that it's going to be time to wrap up. So if you want to reply to Andrea directly in the chat, Caroline, do you want to say something about Andrea's question or about the underlying?
Yeah,
Go ahead.
Yeah, so I think it's a good question. I do think sort of non-economic capital is an important factor in unlocking the market, right? So we're monitoring closely what the DOE is doing through the Loan Programs Office. They've got 40+ billion to invest there, so we're interested to see how the first dollars flow. But I would say that we see, especially in the industrial decarbonization space, we see opportunities that are already economic, right? So where we can capture mid-teens and above returns from funding, for example, thermal storage on-site at industrial facilities, and from funding carbon capture and sequestration that's oriented toward decarbonizing ethanol production, for instance. So those are opportunities where you can capture, core plus infrastructure and even more private equity-like returns. And so there isn't a need for concessionary funding to come in and unlock those markets. I think for areas like small modular nuclear, for instance, you will need some sort of concessionary funding or an out-of-market contract, right, to help support deployment, at least for the first few systems. So it really varies by asset type. But happy to, if you have other questions, happy to chat offline.
Okay. So yeah, we're going to have to take it offline for the other questions. So the two questions from Andrea and Alice, I'm going to give them to the speaker, and they're going to be able to reply offline.
Thank you so much, everyone. I'm sorry I have to cut this amazing conversation, but we have to let the floor to other panelists and amazing conversation. Please, attendees, do not hesitate to join either this track or the other one. We have a lot happening today. Thank you so much, French Tech Austin. Thank you so much.
You're welcome.
Caroline, Laurence, Ludovic. It was just amazing. Thank you and see you soon.
Have a good forum. Bye-bye.
Bye.
Thank you. Bye.
Thank you. Bye-bye.